Good morning, everyone. Thank you for joining us for the webinar today. First and foremost, we hope you and your families, colleagues, and friends are safe and healthy. SC&H Group remains committed to providing content and events like these as we continue to navigate the challenges around the business impact of COVID-19. We hope that today's content will provide additional insights on the many nuances of maximizing PPP loan forgiveness, whether you've already received one or are still holding out before applying. Just a few housekeeping items before we get started. We will be recording this webinar. It will be emailed to you by tomorrow, June 3rd. You can also visit schgroup.com and we'll have it posted on our website. We received a lot of really good questions ahead of the webinar, and we're going to get through a lot of those today. A lot of the tailored content for today's program is to address those questions. So thanks a lot. And Jim, Greg, and James will also do their best to answer any questions that come up during the webinar as time permits. If your question is not answered and you're an SC&H client, please reach out to your SC&H engagement team for immediate assistance. If you're not an SC&H client, we'd love to introduce ourselves, and you're welcome to reach out to Jim, Greg, or James, and they'll point you in the right direction. Before I turn it over to our speakers, it's important to note that this information is very fluid. The content and advice we are presenting today is our interpretation of what is available at the moment. And all businesses need to continue working closely with their bank, attorney, and accountants. As we're recording this, we're anticipating some potential changes this week from the SBA or some additional legislation from Congress. So again, today is what we know as of now, but please continue to check back with us. Our webinar will be led by Jim Wilhelm, Director in our tax practice, Greg Horning, Director in our personal financial planning practice, and James Eaton, Principal in our tax practice. And now I will turn it over to Jim, who will kick things off for us.
Thanks, Colin. Welcome, everyone, and I hope that everyone is doing well. Thank you for joining us. Thank you for being a client and or a friend of the firm. And thanks for folks who sent along thoughtful questions prior to the webinar, which we think will help inform everyone who is attending. We want to get started with our first slide, how to apply for a PPP loan. I know that many of you listening today already have a loan, but there is still an opportunity to get a loan. And if we look at the legislation that's currently passed by the House and perhaps headed to the Senate, it looks like one could apply for a loan, not just through June 30th, but potentially through December 31st. In terms of what we know today, there appears to be somewhere between $130 and $140 billion in funding still available. So it's time to grab the right banking partner and your accountant and potentially legal counsel and look at getting that loan app in if you haven't done that yet. You'll need to get your documentation in order. Your bank should be able to help you with what you need and in what format that will be and help you determine the loan amount. All the banks have gone through this not once, but twice. So at this point, I think they're in pretty good shape to give you good advice. If your loan is going to be over $2 million, but even if it's not, you're going to want to do a nice job documenting the need for the loan in terms of addressing concerns that the SBA was lending money to companies that really didn't, quote unquote, need it. There's been a lot written about that. So if you're over 2 million, you definitely need to do a thorough job here. But if you have a very strong balance sheet and your loan is under 2 million, you'll still want to take that into account. Assuming you do go out and get a loan and it's new money, just as we advised folks before, you'll want to think about the plan. Is the plan to spend all the money within the covered period? And we'll talk about what that is and what that might be shortly, and have all of it or as much of it as can be forgiven. Or is there a better plan where some of the loan proceeds remain and you have a very low interest, no collateral, no personal guarantee loan and have those funds available to you 2, 3, 6, 8, 12 months from now. Or maybe there's a strategy where you do some of both. So I think folks need to think about that. There are also other options out there for folks who either don't want a PPP loan or the loan is not enough to get them through these times. There are some state and local grants still available, primarily local at this point, i.e. at the county level. There is the employer retention credit, which is specifically for employers who do not or cannot benefit from the PPP loan. There is payroll tax deferral, which allows employers to retain employer Social Security tax, effectively an interest-free loan from the government for some period of time. There will soon be, we think, a Main Street lending program, which has been very slow to kick off, which would be applicable for companies, again, who either could not get a PPP loan or chose not to. Then, of course, there's traditional bank or equity financing, which may get you through periods either now or after the PPP funding has gone away. I'm going to kick it over to Greg, who's going to walk us through the covered period and related implications.
Great. Thanks, Jim. So on covered period, this has been a little bit of a moving target, but by and large, it's a relatively straightforward concept. The spending of and calculation of forgiveness related to the PPP loan proceeds is currently dependent on a 56-day period or an 8-week period that begins under the general rule, begins with the date of initial funding. We know that early on there may have been cases prior to Treasury guidance where funding may not have occurred in one lump sum. So what matters here is the date of initial funding, when the business first received cash from their bank. That begins the 56-day clock. Since that time, we now have guidance that that a business can elect, if they so desire, to match up their pay periods more efficiently with the covered period. And this would allow, if the employer has biweekly or more frequent payroll periods, they can elect to use a 56-day alternate payroll covered period, beginning with the first day of the payroll period beginning after initial funding. So, if you make this election, you're going to look at your funding date and determine what next pay period begins immediately following your funding date, and begin your 56-day clock there. Importantly, if you make this election, the covered period applicable to payroll will likely differ from the covered period that applies to other expenses. So again, this is only applicable to payroll costs, not to other costs. For other costs, your covered period remains the 56-day period beginning with initial funding. And also importantly, the election is not available as written under the guidance for any employer whose pay periods run less frequently than bi-weekly. So in thinking about planning for this, I think that when you have a bi-weekly or more frequent pay period, it's going to behoove many employers to look at which payrolls will get captured under either alternative, whether the general covered period or the alternate covered period, and which would put you in the best position to maximize forgiveness. And that's going to be determined really on a business or by business or employer by employer basis. So I'm going to cut my comments there. There'll be several questions we'll come to later on on covered period, but we'll move on to payroll costs that I think Jim is going to cover.
Thanks, Greg. So Greg talked about the 56-day period. And in the IFR that came out a couple of weeks ago, as well as in the loan application, the verbiage that is used is payroll that is paid during your covered period and payroll that is incurred during your covered period. And so there is some debate out there as to whether or not a borrower could allocate more than 8 weeks of payroll into their covered period. If the calendar just fell your way and you had, as an example, a payroll date early in your 56-day period, and then on the back end of your 56-day period, you have a substantial amount of payroll incurred that isn't paid until after your 56-day period, could you get 8.5 weeks, 9 weeks, maybe even up to 10 weeks for some semi-monthly payroll employers? So there is, I think, some debate among commentators out there. If we look at the wording in the IFR and in the loan application, it says for payroll paid during the covered period and payroll incurred. It doesn't say paid and incurred or paid or incurred. So more guidance from the SBA would be helpful here, maybe some examples that would walk us through that. It's been interesting. The SBA is pretty much tried to ruin every weekend for the last month for accountants and those advising clients and companies regarding PPP by issuing guidance Friday night around 6 or 8 o'clock at night. This past Friday, they did nothing. And one might think that maybe they were waiting to see what Congress was going to do before they issued further guidance. And we'll talk about that a little bit later. So paid and incurred is still, we know more about it than we did when we provided our last webinar, but we still have a question or two. But it is clear that everyone should get at least 8 weeks of payroll during their 56-day period under the definition of paid and incurred, which is helpful. More guidance should help answer the final question or two. Health plan costs, if you make your premium payments during your covered period, it seems pretty clear that that would be eligible for forgiveness and work. What is not yet clear is what about self-insured health costs? They haven't issued any guidance there. If you incur the cost during your 56-day period and you pay it the following pay period or the following bill cycle, it would seem that that would be includable. But self-insurance works a little differently than those of us who have third-party insurance premiums that are due generally on a monthly or even more frequent basis. So still a question mark there. Retirement plan, frankly, a huge black hole of guidance here. We don't know any more than we did weeks ago, unfortunately. In the application, in the IFR, it talks about retirement plan payments. So that might be instructive. Payments of what and for what? No guidance. Is it your 2019 contribution that is due perhaps September 15th? Maybe, probably, if you pay that in your period. I feel pretty good about that. What about your 2020 expense? Some companies pay the match in a 401k plan as they go. That would seem like a reasonable expense that would be forgivable if paid during your covered period, and even if accrued and paid in by the following pay date. That would seem to work. For companies that wish to prepay some of their 2020 expense, would that qualify? Again, we don't have guidance. It would seem like 8/52 of your 2020 estimated expense if you pay that in a covered period. That seems pretty safe. Just to accrue it and not pay it, I think that's less likely to qualify. But again, we just don't have any guidance. We've had some clients ask if they can prepay half of what they expect to pay for 2020 since we're getting close to the end of June. Again, if it's paid in the covered period, I feel better about it. In terms of what retirement plan costs would qualify, you know, the 401k plan, set plan, those things all make sense. Deferred comp, ESOP, don't know yet. Other types of supplemental executive retirement plan. Contributions, again, we don't have a definition there, but I think a best practice would be if you're going to pay your 2019 contribution sometime this summer, you probably should get that paid during the covered period. And I think a second best practice would be if you feel comfortable that you're going to make a 2020 contribution of a certain amount, having 850 seconds at a minimum of that paid in during the covered period would be a good idea. State unemployment tax, I think that's pretty straightforward and not a big number for most people. If it's paid during the period, you're good. If it's incurred in the final pay period and you pay it at the next bill cycle, which I presume would be the next time you file your unemployment report, that should count. New in the IFR was commentary around hazard pay and bonuses that employers might be giving to people who are working now during this environment, and that would be eligible and forgivable, again, subject to the overall cap of $15,385 for any employee payments during the covered period. A couple of new things came out of the guidance. One, a new term of art, owner employee. Two issues there. One, for owner employees who own more than one business, compensation of $15,385 is capped across all businesses. No further definition there, but it would seem to me that you can't take $15,385 out of multiple companies if you are said owner employee. There is a cap for owner employees of 850 seconds of 2019 cash comp, which is similar to the rules in place for self-employed individuals and partners in a partnership. So I believe what the SBA is trying to do here is limit the ability for owner employees to increase their comp in 2020 over levels they had in place in 2019. Again, you're still subject to the $15,385 cap for the 56-day period, or whatever is actually paid. So best practice here, owner employees should get $15,385 paid during the covered period, and make sure you're looking across multiple entities if that applies. As I mentioned, self-employed individuals and partners, your cash comp is capped at 850 seconds of your 2019 income. We are recommending that you take a draw during your covered period of that amount to make sure that gets qualified. You have proof of a payment and you have less of a story to tell down the road when you request forgiveness. And for those self-employed individuals and partners, your retirement plan and health plan costs do not count towards forgivable expense. And for owner employees, it appears in the IFR language that retirement plan and health plan costs are capped at 2019 levels as opposed to 2020 levels. James is going to walk us through a couple slides on non-payroll costs now.
Thanks, Jim. So non-payroll costs were sort of in the original law, which seems like a lifetime ago. They were sort of just something that was left there to help the business, to incentivize the business to do this, right? The real core of the law was the compensation replacement. So there were some definitional things we can work our way through. And the first of those is what kind of costs are eligible, okay? So non-payroll costs are made up chiefly of three things. A term called mortgage interest, which we'll talk about, rent or lease payments, and utility payments. So mortgage interest normally, as defined in sort of all tax law, has for years and years taken the definition of having to be collateralized against real estate. However, the SBA and Treasury and the additional guidance we've received is now makes clear that this really is business interest on real or personal property. So that's interest on debt incurred before February 15th, 2020. And it does not include prepayments or the principal portion of payments. So if we've got a business and we own our own building, then the mortgage interest on the mortgage for the building is a qualified non-payroll cost. Great. That's real property. The personal property angle here is if you've got a loan for autos, over-the-road trucks, maybe even copiers and office equipment, then in a scenario like that, as long as you've got that note and that loan was papered prior to February 15th, 2020, then the interest, again, the interest portion of those payments is a qualified non-payroll cost. The pay down of the principal is not a qualified cost. So similarly, that's if we own real estate or if we own tangible personal property within the business. What if we rent those things? Again, then the rent payment or the lease payment for our real or personal property is a qualified non-payroll cost as long as the lease was in place before February 15th, 2020. So again, if we've got a building, got a warehouse in our business, we're paying $10,000 a month in rent for a lease payment. Hey, that's great. That's going to be an includable non-payroll cost. What if we've got an auto, we've got an over-the-road truck, we're in a long-term lease there, but we don't own it, right? It's still on the books of the leasing company or the original owner. Well, in that case, the lease payment is a qualified non-payroll cost. Both of those, for the most part, are relatively straightforward. Utility payments, which seem sort of should be relatively straightforward, have some fungibility. So we look at utility payments and we say electricity, gas, water, those are the things that the law sort of said, hey, those things are traditional utility payments, and that makes a lot of sense. But then we get into telephone and internet. I know we had a question about security systems. Those are a little bit tricky, right? And it's really the regulation, as the guidance has sort of put together, says, you know, we are looking at the distribution, the supply of these things. So you know, we had some questions maybe about, hey, what about if water is a utility, what about a water filtration system? And I think that's a case where likely the asset, the filtration system, is not a qualified non-payroll cost, but the actual provision of the water is. Also, the application, the forgiveness application that came out recently, inserts the term transportation, and we get very little guidance on what transportation is and why that would be considered a utility. There's an interim final rule that gives an example, and it says, as an example, the gasoline that you put into a business auto used for business would qualify as a utility payment. So the auto itself wouldn't be a utility, but the gas, maybe the oil that you put into it could. So you'd say, hey, what about the auto itself? Hey, if it's a lease, then that lease payment is going to qualify in the line item above, the lease payments for real or tangible personal property. And if you purchased the auto, then the interest portion of the monthly payment would qualify as a non-payroll cost. So definitionally, that's where we are in the definition of non-payroll costs.
Okay. Okay.
So then we look at some of the same sort of definitional questions about what costs count, right? So eligible costs, as currently defined, are amounts paid during the covered period, excluding the prepayments we talked about that are specifically disallowed above. Great. But there are also costs that are incurred during the covered period, but paid on or before the next regular billing date. This sounds a lot like the payroll discussion that Jim was having just a couple of minutes ago, that we're saying, hey, if you've got some bills that are paid inside the covered period, that's great. And then if you've got expenses that are incurred, but you can't pay them, right? You don't know what your electric bill is going to be until you get the electric bill. What do you do? So let's think about that example. And again, this will parallel maybe some of the things Jim talked about in the payroll discussion. Let's just say our utility bill, our electric bill, runs on a calendar month, okay? So we come along and we get a bill, the monthly measurement period ends at the end of March, bill comes on April 5th, and it's due in 10 days, so we pay it on April 15th. Okay, great. And if we got funded from our PPP in the third week of April, maybe that's April 25th, well, that payment on the 15th wasn't inside the covered period. Okay, so the payment that I make in March, in May and in June will be covered. But my payroll period, my covered period ends at some point in the middle of a month, and I don't get that bill until early in the next month. That's where we say, okay, the amounts you pay during the covered period pretty obviously count as non-payroll costs, but a prorated portion of that final kind of bill for the half month, as long as you pay it on time, on or before your next regular billing date, that will also, that prorated portion, that number of days analysis will count as a non-payroll cost. So this is an area where the current regulation is a little bit more clear and gives a little bit more flexibility to the business owner than what was maybe originally in the law. And I think Greg's going to talk to us about some additional analysis here.
Yeah, so we're going to move and talk a little bit about quickly about the reductions in forgiveness that might apply. There are really three areas. The first is relatively straightforward. Any advance payments on an idle loan that was received, that's generally the $10,000 or in some cases $1,000 ahead, that was paid in the form of an advance payment. That's going to come right off the top on the application for forgiveness and will be applied, effectively, so you don't get a double benefit of effectively a grant and a forgivable loan up to the amount of the advance payment that you received. Second, there are also potential reductions in forgiveness as a result of a reduction in FTEs and or reductions in compensation beyond 25% for any employee that had an annual pay rate of $100,000 or less. So we had a number of questions come in about how do I calculate FTEs. That hopefully I can clear up some of those questions right here. Any employee who worked previously a 40-hour or higher work week is counted as 1.0 FTEs, and anybody that's working less or average less than 40 hours a week during the testing period would be counted as either, at your election, either a fraction based on the actual average hours worked divided by 40, or by election, you can choose to treat any part-time employee as a 0.5 FTE. So in many cases, you can do some analysis of that FTE count and make a determination as to which option is better for you at your election. Second, with respect to compensation reductions, that again only applies to employees who were previously paid at a rate of less than $100,000 annualized, and to the extent that you reduce their comp by more than 25%, there will be a reduction in forgiveness. However, the new guidance that we've received allows and provides that you won't be penalized for twice for the same employee. So for example, if you had an employee who you cut back their hours and as a result their compensation also was reduced by more than 25%, you don't get penalized twice by that same employee. So that was a favorable guidance or taxpayer friendly guidance that we received just a couple weeks ago. We also have another friendly guidance provision that allows that FTE reductions are not going to be imposed if the employer made an offer to rehire the employee, right? But so if you laid off or reduced hours for an employee, but later went back, tried to rehire that employee, or tried to increase their hours, and that was a written offer, and the employee did not take advantage or did not accept the offer, that individual situation will not be counted against you in the forgiveness calculation. So in order to qualify for that provision, you're going to need to have a written offer of rehire or reinstatement at the same prior hours and pay rate. You're going to need to show that the employee or former employee rejected the offer. You're going to need to maintain those records and be able to provide those to prove that down the road. And in addition, one of the more interesting provisions here is you need to notify the state unemployment office that the employee chose not to take advantage of a rehire offer. And the final comment in this section, really on with respect to FTE reductions, if you have an employee who you terminated for cause, voluntarily resigned, or voluntarily reduced hours, those employee reductions or comp reductions will not, those FTE reductions will not be counted against you in the forgiveness calculation. So if an employee has reduced their hours and comp is reduced as a result, only the impact of the FTE reduction is applied to reduce the loan forgiveness. The fact that the employee's comp dropped by more than 25% can be ignored. With that, I think Jim has some comments on what we might be looking, the biggest questions we have remaining, and then we're going to jump right into Q&A.
I think we can think just a little bit about the application process, the forgiveness application process, and some of the logistics that'll go into that briefly. As of today, given the way the law and the regulations are set up, we're anticipating that the banks should sort of have the bandwidth and some process together late in June to start working through applications. And the math there sort of says, the earliest grants, earliest awards were coming out in middle to late April. So by middle to late June, hopefully the banks are starting to accept the applications. And presumably, famous last words, the banks will be better prepared to accept the forgiveness applications than they were for the loan applications. When we look at applying for forgiveness, there are a couple of timing strategies we might consider. One is in coordination with tax deferrals, payroll tax deferrals. You might be beneficial to those who have taken advantage of payroll tax deferrals to delay the application of the loan forgiveness in order to maximize that deferral. Another one is the concept of sort of safety in numbers, sort of like filing your tax return in March. If a lot of applications are filed sort of at the same time as people are trying to get forgiveness worked out, then maybe there's less of a chance of the IRS or someone, Treasury, SBA, coming back and looking at in more detail at the forgiveness application. So we'll see, and Jim's comments, I think in a few minutes, will have some impact on maybe some of these timing issues. As far as the documentation goes for employers with employees, the guidance and the regulations have given more and more color on this over time, but certainly payroll tax returns are going to be fundamental to that. Now, whether or not the payroll tax returns line up with the covered period and the costs that are payroll costs that are includable is debatable. May work in some situations, likely won't work to the dollar in other situations. But that'll be a core area where you'll need to provide payroll and unemployment type reports to support people on payroll and how much they were making. Checks for outside items like health insurance, retirement plan payments, those sort of things, I think we'll also add to that. There is some specificity in the interim final rule regarding utility payments. Those same sort of rent and lease obligations, they'll actually want on a business mortgage, they want to see the amortization schedule, the loan documents with a date prior to February 15th, 2020. So there's going to be a fair amount of documentation that'll go into kind of a pile that'll be supplied there. The FTE computation may be very straightforward for some folks, some businesses where you have 8 or 10 or 20 people that are all full-time. That'll be fairly straightforward. For more nuanced folks with more part-time or with seasonality, with larger headcount, the analysis may be a little bit more detailed and payroll register with a cover sheet talking about how the math actually works may be really recommended. And then sort of anything where if you're making a payment during the period that you want to count, you want to think about having cancel checks or if nothing else, kind of a bank statement showing that going through and clearing. And if you're going to have the accrual or the kind of incurred and paid before the next bill date, then you want to have that next bill and you want to sort of have the check and say, hey, here's where it was, this is the date, this is the period it covered, and this is when I paid it to support those costs that are coming outside of the 56-day covered period. Our recommendation is you plan to keep this in a safe place for a long time. SBA has said that they will examine all files for greater than $2 million, but they've also left the door open to say files smaller than that will be examined as well. We don't have any statistics on how likely that is, but they've got a long window of that. So keeping all the support, probably photocopies or copies of all of your support, all of the right from the application right through the forgiveness is really our recommendation. So I think at this point we'll ask Jim to talk to us about a few of the open items, a few of the things we need to keep in mind as we move forward.
Thanks, James. A couple things to add maybe on the loan application itself. I believe we have a link on our website on the Resource Center, which is a good place for people to keep an eye on over the next couple of weeks. Whether we hear from Congress or the SBA, we will get things out there, hopefully in a readable and concise format for our clients and friends of the firm within a day or two. And I want to continue to thank our marketing department, who is rowing right alongside all of us in keeping our clients up to date. A couple notable things on that app. One is it expires October 31st, which kind of makes sense because initially PPP was supposed to go away at the end of the year. So if you need to apply by October 31st, the bank has 60 days to rule on forgiveness or make a decision on forgiveness. That gets you to the end of the year. That's a note. One question on the application asked how many employees you have at the date of the forgiveness application. And that's been a question folks have asked us several times. If we rehire people at June 30, do we need to keep them on the payroll? There is no guidance on that specifically, but they are asking that question on the application for a reason. What's out there? So I'm going to get back to Congress in a second. Maybe I'll work backwards. Sorry about jumping around. So we haven't heard from SBA in a while. I'm not sure I missed them, but we think we should get guidance. We're supposed to get it this week. I think they're waiting on Congress, as we said. Speaking of Congress, they initially were looking to make forgiven expenses deductible. The IRS had ruled they would not be deductible under Code Section 265. I have not heard about any progress on that legislation. We will keep you posted. As mentioned earlier, we would love to have some definitional help on things such as retirement plan costs, transportation, defined owner employee, confirmation that related party arrangements are okay. We haven't seen where they aren't. And so I'm someone who, in the absence of rules, likes to move forward. Will CAM charges count for rent and some other items? Obviously, the banks are going to be giving borrowers guidance on putting your forgiveness application through a portal, what format they'll be looking for, what records they'll want to make this a smooth process. There are roughly 4.5 million PPP loans outstanding that banks need to make a decision on forgiveness within 60 days. So that sounds like busy season for the banks this summer, this fall. Depending. So you'll want to have a nice conversation with your bank to make this go as smoothly as possible. Now for Congress, and then we're going to jump into some questions. There's a House Bill 7010 that's been approved, 417 to 1. I didn't look to see who the one was. That bill will go to the Senate this week. They may act on it. They may act on their own bill and then go to conference after that. The bill itself moves the covered period from 8 weeks to 24 weeks. It changes the 75-25 split payroll versus non-payroll to 60-40. However, the 60% will now be a cliff. If you don't get to 60% of spend being payroll, you get zero forgiveness, which is a change. The June 30 date for restoring payroll and restoring FTE count will be moved to December 31st. You could also apply for loans up to December 31st under the House bill. And the 8 weeks to 24 weeks is kind of the biggest thing. And that may be good and that may be bad. For companies that have already had their money, have spent most of their money, and are using it to keep payrolls where they were before this crisis hit, and have done all of that and would be getting probably full forgiveness or very close to that, they may want to, and the House bill allows, to elect out of the 24 weeks. And the reason would be you have to maintain your payrolls for 24 weeks then, but you were given 2.5 months, of payroll funding. But now you would need to retain payroll levels and headcount for over 5 months, almost 6 months. That might be a challenge. And pushing the measurement date from June 30 to December 31st could also be a challenge, depending on how companies think their businesses will do later in the year relative to now. So those are kind of the highlights. Again, please keep an eye on our resource center. We are adding a blog. Even though it's slowing down a little bit, it's still once or twice a week. And as soon as guidance comes out and/or Congress acts on the PPP, we'll call it extender or flexibility legislation, we will get something posted there. All right, so let's jump to questions. I think I'm going to start, and we'll talk about payroll. So first question was payroll to family members. Again, related parties, we think it's fine. You have to watch for your caps. You need to look at owner-employee caps, which are now based on 2019 as opposed to 2020, but paying family members should be fine. There's nothing in there in the legislation or the guidance from Treasury that talks about that. New employees, if you hire a new employee now or recently, are they included? Yes, they do not have to have been working for you earlier this year or last year. Let's see. There was a question regarding 75% rule. So I know some people are thinking you must spend 75% of the loan proceeds on payroll in order to get forgiveness. And then there's a question whether it's 75% of the forgiveness has to be a payroll cost. And the answer is, of the amount forgiven, 75% must be used for payroll costs. The remaining piece can be for non-payroll costs. You can have partial forgiveness under the current rules. And if all of your loan is not forgiven, you would then have a new loan with the SBA subject to the terms outlined previously. Severance pay will qualify. Again, you have to watch your cap for any employee. Compensation over $15,385 during the covered period will not count, so you're capped at that number. Payroll is paid or incurred. So you start with your first payroll after the loan proceeds were received, and you can accrue some of the payroll, the portion that was earned during the end of your 8-week period, as long as it's paid in the following pay period. We talked about the FTE calc. That was a question. Independent contractor spend does not count. For part-time salaries, that counts, obviously, and you have to go through your FTE calc, new employees calc. If you add employees, God bless you, that counts. Transportation, we believe, as James alluded to earlier, so far all we know is it's fuel used in company vehicles. Hopefully we get guidance on whether that will be more than that. For FTEs, Greg talked about if employees were fired, they quit, they refuse to come back, that will not hurt you in terms of the headcount reduction calculation. And I think my final payroll question really just gets back to incurred and paid. And again, if your final payroll during the 56-day period falls outside of that time frame, you still can include the portion that was earned through your 56-day period, as long as that is paid in the following normal pay date. James?
Super. So I think we have a few questions about non-payroll costs, and we've covered a number of them, but we'll run through just a few things. I think Jim has discussed it, and we've discussed it with respect to how do we count this, but some folks have said, okay, so are we on a cash versus an accrual basis? And that sounds like a very accountancy sort of thing. I think what we think of internally is it's sort of a modified cash basis. It's cash basis, except for special rules that allow you to essentially accrue some expenses at the end of the period. There's been a fair amount of kind of ambiguity and questions about transportation. And so again, it's a sort of a very definitional question, right? So people say, hey, what about the purchase of a vehicle? Well, the purchase of a vehicle likely is not a non-payroll cost, but let's think about that. If it has interest on it, then the interest would be on a note, which would be a business note. So the interest could be deductible as long as the note was in place before February 15th. The purchase itself, the paying for an auto is a principal activity, right? So we know in the definition of business mortgage that the principal portion doesn't count. Equally, I guess many auto dealers now have 0% financing in today's world. So the interest may be less and less of an issue over time. There was a great question about, is a security system a utility? I'm sort of inclined to think yes, it's the provision of a service. If you're not buying physical hardware, then it's sort of a monthly bill for the distribution and provision of a service. So I think that one you can probably think about. There are a few questions about payroll costs, and we can just hit a couple of those maybe real quick. Someone asks, is severance or separation compensation forgivable? Severance pay is, I think, in the definition of qualified payroll cost. So that one is pretty straightforward. And there was another question that kind of came through on FICA versus Medicare, what to know there. I think the important thing to consider there is that the employee's portion of FICA and Medicare is includable both in the application for the PPP funds and for the forgiveness, but the employer's portion isn't. And that's essentially because the employer's matching Social Security and Medicare contribution isn't wages, it's payroll taxes. And so it's an entity level tax, and that's not wages. So that one doesn't count. And I think equally, unemployment is a tax based on the employment of people, so that should be a qualifying payroll cost. So you have less to worry about there. Just touching base again on vehicles, the question about maintenance. Should maintenance count as a utility non-payroll cost under the heading of transportation? We have really one, not even full sentence, it's a sentence fragment. It's between a comma and a period. It's just a little fragment that says, as an example of transportation costs, gasoline in your vehicle would count. So the gasoline, fine, would count. The maintenance doesn't seem to be the type of thing that's included in any of the other definitions of non-payroll costs. So we wouldn't think that maintenance or repairs would be includable utilities from that perspective. And shared payroll costs, shared office costs, you know, if they're included in rent, then I think that probably is a rent, and that's a non-payroll cost. If you have CAM charges, that's a little bit trickier, but if they come through and they're invoiced as utilities, then I think you have a better chance to say, hey, that's the electric or the water or the gas, the heat, whatever else it is for my portion of common areas. So I think that makes sense. Greg, what do you have?
So I'm going to pick off a couple that came in online while we were speaking real quick. First, I don't think we've talked a lot about independent contractors and self-employed who file a Schedule C. There was a question, there are two questions here. One, as an independent contractor, does rent for my home office count, and is it forgivable? And then secondly, how do I document as a sole proprietorship? Sole proprietorships are relatively straightforward. The forgiveness calculation with respect to a sole proprietor is going to be with respect to the payroll cost, assuming you have no employees other than the sole proprietor. The forgiveness is going to be 850 seconds of line 31 of your 2019 Schedule C that you file or will file with the IRS. So that's been pretty clear from relatively early on. In addition to the 850 seconds of line 31 of Schedule C from last year, you can get forgiveness on other costs, non-payroll costs. So that would be your mortgage interest, rent, utilities. But for many of those self-employed individuals, that mortgage interest or rent would be their potentially a home office, and that comes to the second question on is home office rent forgivable? And so for that, we would be looking at 850 seconds of those costs, rent, mortgage interest, utilities, 850 seconds of those costs that should appear on a filed Form 8829. Again, I think the guidance has said, you need to have filed an 8829 with your 2019 tax return or plan to do so in order to support that forgiveness calculation. Another question that came in with respect to covered period, if you elect the alternate payroll covered period, does that apply to benefit costs? Well, benefit costs are part of the definition of payroll costs. So if you elect the alternate covered period for payroll, then I would expect that your benefit costs would also be subject to that alternate covered period. But when I made the reference to other costs, I mean non-payroll, which would be mortgage interest, rent, business rents, or utilities. And finally, another question on a comment I made about EIDL. If you received a grant, an advance payment under EIDL, which is not required to be paid back, yes, that means that if you received a $5,000 EIDL grant and you received a $20,000 PPP loan, your forgiveness on the PPP loan would be limited to $15,000 because you don't have to pay back the EIDL grant. A number of questions came in, and by the way, folks, I know we're coming up on 12 o'clock. I think we have a number of questions we're going to try to get to. We may go a little bit over. And if that happens and you need to jump off the call at noon, we are recording this and we'll be posting it to our resource center, so you can always come back and listen to the tail end if you need to jump off. But number of questions came in about alternate covered period and payroll. So, somebody asks, alternate covered period begins 4/19, did not furlough any employees, but reduced wages to 75% of base for some period of time and then jumped them back up to 100%. Well, based on that information, it doesn't sound like there'd be any reductions in forgiveness, but I'm going to say that I wouldn't make that assumption. The computations under reductions and FTE calcs are somewhat complex and looking at specific periods of time. So I'm going to encourage you to do some calculations to ensure that you truly didn't reduce FTEs or compensation. Self-insured, this is a question I think Jim tried to address a little bit. That there isn't much guidance on self-insured health insurance claims. There are people out there, there are advisors that believe that you should be able to claim or get benefit for claims that are paid during your covered period. Others are saying, well, maybe it's COBRA rates applied to your census during the covered period. All we can say on that is stay tuned, hope for guidance, talk to your bank, because the bank at the end of the day is the arbiter on these forgiveness calculations. So somebody asked, look back period. Company had an employee quit and take another job. Company hired new employees such that there were no changes in FTEs. Will this resigned, terminated employee need to be included in the salary wage deduction calculation? So the worksheet in the forgiveness application includes only employees who were paid during the covered period. So as a result, their termination, the termination of the prior employee should not result in any penalty for the reduction of compensation by more than 25%. However, the termination would result in a reduction of forgiveness, except for the fact that you replace those positions completely. So as long as you brought your FTEs, your average FTEs back up by the June 30 date, in that instance, I would not expect to see a reduction in forgiveness. Somebody asked, how strict is the 8-week forgiveness period from when the funds are transferred? If we received money early May, can rent for July be eligible for forgiveness? Well, the 8-week period is absolute. Now, for payroll purposes, you can choose that alternate covered period, but until Congress makes a change, and except for that alternative to use the payroll alternate covered period, you have 8 weeks beginning on the day of loan funding. So in this question, if you paid your May and June rent within the covered period, and you also pay your July rent in the covered period, we believe that all three of those payments would be captured. However, if you pay your July rent after the end of the covered period, we still believe that you should be able to get a portion of that July rent, and that pro rata portion would be based on the number of days in July that rent payment applies to, up to the date where your covered period ends. I think that should do it there. There's a very complex question where maybe I'll just touch on this briefly. We have an employer that has 3 separate payrolls, so a weekly payroll and 2 separate groups of employees that get paid bi-weekly. Here, this is like any other situation, except that you need to evaluate each group separately. So in their situation, they say the loan was funded on April 22nd. So from April 22nd, if we count forward 56 days, you're going to have till June 16th to cover for your covered period. So any payrolls for any of those groups that are actually paid between April 22nd and June 16 would be included. In addition, for each of those groups, there may be, under our interpretation, an accrual for some number of days between the date of the final payroll that's paid in the covered period, and June 16th, where you can include the accrued payroll as long as that payroll is paid no later than the next regularly scheduled pay date. I'm going to stop there. Jim, James, do you want to jump in on any other miscellaneous questions?
I have a couple here that I'll run through under retirement plan and benefits. Again, we touched on it briefly. 401k match for 2019, if it's paid in a covered period, I think you're good. An accrual for 2020, not sure yet. Prepaying some of 2020 during the covered period, again, I think it is reasonable. Benefit plans that would count as a payroll cost would be health, disability, and dental. We also think HSA, the employer portion, would also count. We have one question here where someone made their 401k matching contribution in March. Would that be included? And I think the answer to that question would be no, because it was not paid during the covered period. You could not have a covered period that began in March. So since it wasn't paid, and the verbiage in the guidance to date is payment for retirement plan, I think paying that in March is not going to help you here. However, you can think about making a payment towards 2020 if you think. James, you want to grab a couple more before we sign off?
I think that's great. Yep, there are a few really good ones here. So one of the real fundamental questions here, someone says, hey, I paid 3 rent payments during the covered period, right? I had one that was due right after I got my funds, and I paid the next one, and then before the end of my 56-day period, I paid another one. I got 3 in there. Does that count? I think that really goes back to some of the fundamental ambiguity we see here. That was probably one of the reasons why the original law said paid and incurred. But it seems that there is no disallowance for prepayment of rent in the current law. So I think you probably can get that as long as you're paid inside the 56-day period. So that's probably beneficial to business owners. Another question, hey, I've got monthly IT server and cloud hosting costs, and do you think those fit into the utilities category? Not surprisingly, we don't have an exhaustive list of everything that's utilities. But I think my thought process there is that's similar to internet provision, and you might have a chance there in the absence of greater detail. I think you got a chance there. That's an okay one. A really interesting question that someone posted is, hey, we said that lease payments count as non-payroll costs. What about capital leases? I've seen a few articles, and I don't know if you guys have seen anything that I haven't, a few articles that essentially take the position that capital leases really aren't leases for the purposes of PPP, and that really it's a financing arrangement. And so what you really fall into is looking at it like a purchase, where the purchase of your equipment is not a non-payroll cost, but if there's an interest function baked into that number, that the interest function would be a non-payroll cost. So that's one where we have less than no guidance in the regulations. What do you guys think? You seen anything that's interesting in that vein?
I mean, I have seen, the SBA is not the IRS, and so, oftentimes capital leases are characterized that way for either generally accepted accounting principle purposes or tax purposes, neither of which typically apply to the SBA as it relates to lending. So that's actually, that's a tough one. If you explain it to a 10-year-old, it looks and smells like a lease, right? It says lease on it, but you could argue economically it's a financing, situation. So tough one.
Here's a relatively quick one that somebody just posted a few minutes ago. Can you confirm that independent contractors are not allowed to claim health premiums and contributions to SEP retirement accounts? Well, yes, for an independent contractor, so this is likely a Schedule C filer assuming that they don't have any employees in their business other than the self-employed individual. We believe it's clear that health insurance premiums, self-employed health insurance premiums, and SEP contributions for the owner are not includable. Again, we're back to the 850 seconds of Schedule C from 2019. If the employer, if you do have employees on Schedule C that you're paying and you're making employer contributions to their health premiums and or IRAs or SEP IRAs or 401ks, those contributions for those employees only would be includable if paid in the covered period.
All right, folks, what we're going to do is we're going to stop this for today. We've seen a ton of questions coming in. I'm going to work with the team to get some questions answered. But thank you very much to everyone for joining today. Thank you very much to Jim, Greg, and James. We definitely encourage everyone to visit and bookmark our Coronavirus Resource Center for the most up-to-date content we have published. This page is continually being updated with new content as more information comes out, particularly when there is more definitive word from the SBA or Congress. Again, we will email out the recorded webinar by tomorrow, so keep an eye out for it. On behalf of all of us here at SC&H Group, we wish you, your families, your businesses, and your colleagues the best as we all look ahead. And if we may be of any assistance, please don't hesitate to reach out to us. Stay safe, stay healthy, and thanks for being with us today. Take care, everyone.
Thanks all.
See you, folks.
Thank you.